In this video, I'm going to be sharing my opinions on the bullish arguments facing the stock market today. If you haven't seen my previous videos, the first one being the overview of all the arguments and also my opinions on the bearish arguments, check the description below and I'll have the links for both of those videos. So in this video, I'm going to be sharing my bottom line opinions on the bullish arguments that I talked about in my first video, stock market recovery or collapse. Let's get right into the first one. I'm on a wave, slept on, no, I got next on. I'm on a wave, I'm on a wave. The first bullish argument is long-term vision is key. First off, this is not really a valid argument for whether or not we're supposed to hold on to or get into investments for the next 6, 12, 24, 36 months in the stock market. If you are a long-term investor, then you should be focusing on the long-term trend and taking into account information that might impact that trend in the medium term, because we all know that the long-term trend is up. Therefore, a long-term investor's only concern are events that bring systemic risk where you might have a recession or even a full-blown depression. Therefore, let's say that we're looking in the medium term. We're looking at the next 1 to 3, maybe even 5 years, which is what these videos are more gauged towards. Saying that you're a long-term investor isn't really a valid argument for why you should hold in the medium term. As long as you can take the risk of the medium term for your long-term investments, then that's fine. But it's not necessarily a direct argument for why you should hold in the medium term. I don't think there's anything wrong with investing in the medium term because of your long-term plan or your long-term outlook on the stock market, as long as you can weather the storm and tolerate the risks that the medium term may offer. This is an extremely important topic, and it's especially so for those that have their hard-earned life savings invested in the stock market. And so because of this, I'm going to make a whole separate video about long-term investing and certain tips that I think everyone should be aware of, and so that long-term investors have financial security and certainty in the future, no matter what it holds. The second bullish argument is pent-up demand. I personally disagree that pent-up demand is going to create this whole economic boom, and let me share why. While I do acknowledge that there's a massive savings rate right now, it's important to note that it's an abnormal savings rate because our economy was abnormally shut down. As long as there is perceived risk in the economy, and not to mention a partial or total shutdown, then there will be artificially low consumer spending and therefore artificially high savings. Also, economically, this is not surprising because usually during times of uncertainty and recession, there is a higher savings rate because people's incomes are jeopardized and they don't know what tomorrow holds. Whereas during times of economic prosperity, the savings rates are actually usually much lower because people are much more prone to spending and they have employment, and so they're not concerned about saving as much money. So while it's good that people are saving more money because that's probably what's best for them, it's not necessarily a sign that the economy is about to boom. It's really a sign that internally the economic engine is compromised. And while a lot of the surplus money that's being saved right now is going to be re-injected in the future, that doesn't necessarily mean that that in any way is going to make up for the lost productivity and demand in the past. The third argument is that the Fed has your back. Personally, I actually agree with this statement partially and think this is actually one of the strongest arguments for the bulls and the stock market continuing to go up. In the last several decades, the Federal Reserve has done so much meddling in the financial economy to ensure that the stock market and asset prices continue to go up. Lowering interest rates from 5% to 0% and starting up quantitative easing, which is just a fancy way of saying money printing, and creating hundreds of billions and later trillions of dollars is a big reason why the US and the stock market had such a steep recovery after the collapse, the financial collapse of 2009. Just in the last 6 months, the Federal Reserve has already put over $1 trillion onto their balance sheet, buying up treasuries and mortgage-backed securities and trying to push a lot of money into the financial system. They are now hand-selecting specific companies and buying up their corporate debt, and have even talked about possibly going straight into the stock market and buying stocks. The question is, how much can they actually do, and what does the future hold, and how will that impact how the Federal Reserve meddles into the financial markets? Like I said, in my opinion, this is one of the most interesting and probably important bullish arguments to understand and consider. And so if you'd like to see more information on this, let me know in the comments and I'll make some separate videos about it. The next bullish argument is that the stock market is different from 1929. I partially agree with this statement. The stock market has a lot of different characteristics today than it did have in 1929. Let me make an analogy in order to illustrate why I think this is an invalid argument. Let's say we're talking about the world. The world is much different today in the 21st century, especially when we're talking about technologically, than it was in the 1930s. We are way more advanced, way smarter, and so therefore we cannot make the same mistakes. The world does not have the same risks that it had in the 1930s because it is much different today. While our world is a lot different today than it was in the past, and perhaps we've even learned a few things and have gotten better as a society, it doesn't mean that we're not still prone to making massive mistakes or entering another war or still not being able to understand people with different perspectives. Therefore, just because something is different doesn't mean that it still doesn't have the same risks that it did in the past. The next argument is innovation. We're running out of sunlight, so let's get a little light in here. There we go. So innovation. The pandemic has really opened the doors for a lot of companies to do really well. And as we know, tech has been the main driver in this stock market recovery. Demand for companies like Amazon, Netflix, Zoom, and Tesla have boomed in the last several months, and their share prices have as well. As a result, the pandemic has actually created a lot more interest and increased the demand for these shares of these companies. And so while I do personally think that these companies and other companies have a lot of value, I do personally think that the price is disconnecting from the true value of these companies. I think this is manifesting in some kind of speculative bubble that can only be compared to the dot-com bubble of the early 2000s and the roaring 20s that preceded the Great Depression. And so I think this is resulting in a lot of investors panic buying into stocks, not wanting to miss out on the gains while the bubble lasts. While the short-term buying spree continues, I do think this is very concerning for the stock market in the medium term, because while I do think there is a lot of value, I think the prices for these companies' shares are really overinflated. The next bullish argument is that the market is forward-looking and efficient. In order to demonstrate this point in my previous video called Stock Market Recovery or Collapse, I talked about the efficient market hypothesis. First off, this is not really a valid argument for whether or not the market is going to continue going up or down for that matter, because the premise is that the market is always fairly valued because it's taking into account all information. I think this is another argument that can be used as a simple justification for why to hold on to your investments, because by definition, they are always fairly valued. While I do agree with some vague implications and observations that the efficient market hypothesis makes, I disagree with most of the main points. In conclusion, I don't think this hypothesis poses a valid argument for whether the market's going to go up, down, or sideways in any time frame. However, I do think the efficient market hypothesis, like some other topics that we've talked about in this and previous videos, needs a little bit more explanation. And so if anyone's interested about the efficient market hypothesis, let me know and I'll make a whole video about it. The next bullish argument is don't bet against America. I understand this point, and why would you want to bet against America? You're betting against the largest economy. You're betting against a country that boasts some of the largest, most successful, and influential companies in the world, and you're also betting against the country that holds the world reserve currency. However, something that I think people need to understand is that no matter the size, economies go up and down. That's just the natural flow of the business cycle. You have expansions and you have contractions. While natural characteristics of economies have to be understood, it's also important to be aware of other things that are not necessarily natural, like the manipulation of currency, interest rates, and how our current system is so reliant and based off of debt. Therefore, just because we are a part of a great nation like the United States or America does not mean that we are not immune from the impacts of the decisions that we make. So when we're talking about not betting against America, it's more about making sure that you're hedging your bets and you're not putting all your eggs in one basket. So let's look on the flip side. Betting on America shouldn't equal betting all in on America, because you shouldn't be solely dependent on one thing, like we're talking about in this example, the US market, as your lone source of preservation for your purchasing power. This is a broader idea of diversification, not just being diversified in one market, but in a broader sense. But we'll talk about that in future videos. As far as this argument goes, don't bet against America, this is not really a valid argument for the market to continue going up. It's more of an argument saying the long-term vision of America is still up, and so you should still be betting on America regardless of the short-term concerns. I personally disagree with this argument for the same reason I disagree with the long-term vision point. We're not talking about the long-term picture, we're talking about the medium-term picture and the factors at play that will impact the next several years. rather than the next several decades. The last bullish argument, which is one of my favorites, is that the bears are always saying that the market is overpriced and doomed. I think it is true that bears have been saying for years that the market is going to crash any day, while bulls have just laughed at the results. In my opinion, the reason for the polarization between bulls and bears comes from the way that bulls and bears perceive the stock market differently. The bulls perceive the stock market as a mechanism to increase one's purchasing power over time while also avoiding the negative effects of inflation. On the other hand, bears view the stock market as a standing house of cards that's reliant on a hot mess that's referred to as the financial system. Despite this polarization, I think both sides have good reason to have their viewpoints. As long as investors understand the risks that the bears are addressing, but also the opportunities that the bulls are highlighting, I think investors will be set up to be successful. But in conclusion, as far as this argument goes, I don't think it's a valid argument for why the market's going to continue going up. But it is important to remember that people have been saying for ages, and they will continue to say at any given time, that the market is going to collapse. At the same time, there are also going to be people that are very bullish on the stock market, whether or not it's a good time to actually buy in or not. Therefore, I think it's really important to always take the perspectives and opinions of others with a grain of salt and allow yourself to take into account all information and come to your own conclusion. Neither side is necessarily right or wrong, but one side might be more right than another. Despite this, I think each side, no matter what the situation is, has some valuable insight and information that can be understood and taken into account. And so that's why I wanted to make sure to make these videos to cover both sides of the conversation. That's it for this video, and stay tuned for my next video where I'm going to be revealing whether or not I am a stock market bull or bear. Let me know in the comments whether or not you think I'm a bull or a bear, and also about your thoughts about the bullish arguments that I talked about in this video. Thanks so much for watching, and I will see you all in the next video.